good morning, good afternoon from where you're dialing in today. My name is Nidhi Chadda, and I am the founder and CEO of Enzo Advisors. We are a global sustainability practice focused on helping both corporates and investors embed sustainability strategies into their operations and investment processes. We focus on both risk mitigation as well as unlocking value creation for the long term. And in addition to founding Enzo, I also wear a dual hat as a Chief Impact Officer for Richmond Global Sciences, RGS, which is an AI intelligent platform focused on impact valuation for investors. So AI is definitely top of mind in the areas that I work on today. And prior to that, I was in the investment management world as a portfolio manager at RBC in asset management, where I focused on U.S. small and mid-cap equities and focused on spearheading ESG integration, as well as thinking about ESG integration into investing in the long term. So with that, I am also very excited to introduce our panelists today. We have Krishna and Chris here who are joining us, both powerhouse panelists coming from very different vantage points, which is going to make for a very compelling discussion. And I wish we had more time, Paula. That's the only thing I'll say. There's a lot of ground to cover in a very exciting week, particularly with the GTC conference for NVIDIA. So with that, let me first introduce the panelists. Chris, if you can provide a bit of background about yourself first.
Sure. So this is my 15th year with WisdomTree. During part of that time, I lived in London over in the United Kingdom. Today, and for the last 2 years, I've been in Charlotte, North Carolina, just to put a location to where we are at present. And I do a lot of work on our growth equities, our thematic equities. Artificial intelligence is one of our biggest sort of focus topics, as it is at many firms these days, but certainly cover other things like cybersecurity and cloud computing as well.
Great. Thank you, Chris. And Krishna, could you introduce yourself to the group? Oh, you're on mute. Are you able to unmute at the bottom of the screen, or someone can help him?
Oh, there you go. Yeah. Hi, everyone. Hey, Nidhi. Hi, Chris. So I'm a portfolio manager and a senior analyst at Parnassus. As part of my PM responsibilities, I co-manage the value strategy. And as my analyst responsibilities, I cover parts of the technology sector with a focus on the semiconductor space. And prior to Parnassus, I was with Ariel Investments, and prior to that, a long background in strategy consulting and engineering.
Great, thank you for that. So to kick it off, I know we have a lot of folks who are listening in with varying degrees of background on AI and understanding it from an investment lens or a corporate lens. So Chris, if you could kick us off here and maybe provide a little bit of an overview on what does AI mean to you from a thematic perspective? What does the breakdown look like from a technology side of things if we were to look at the value chain, if you will, for AI?
Sure. So one of the things we do at WisdomTree is on a monthly basis, we look across all ETFs, not just WisdomTree ETFs, and essentially try to delineate, and we've so far found, I think, 47 underlying thematic topics. Artificial intelligence is one of those topics. And the interesting thing this allows you to do is it allows you, we've been doing this since mid-2021, so it allows us to look back and to say, what is it that people have gotten either excited about, so you see the line going up, or depressed about, you see the line going down. Things like renewable energy and green technology were huge in 2021, not so much recently. And so you then look and you say AI, when you see these funds called AI and automation, AI and robotics, obviously sometimes in the name you're getting a bit of a hint. But usually the AI funds have a bit of software. They may have a bit of robotics or sort of other hardware. They usually have a bit of semiconductors. Now, in some cases, semiconductors could mean a big position in NVIDIA. In some cases, semiconductors could mean 15 or 20 different underlying stocks. That's more like what we do, because we tend to try to be very diversified across the semiconductors ecosystem, which is fascinating in and of itself. And then you've got sort of your software cloud computing entities. Now, some of your software entities look like Alphabet and Microsoft, gigantic, gargantuan platform companies, and some are far smaller. They might look like a UiPath or a SentinelOne, doing a much more specific and newer software-oriented business mission. And what I'll conclude with is just to note, it was fascinating to watch for the last 2 years. People in the US put more than $40 billion in semiconductor-specific ETFs. So not even AI ETFs, semiconductor-specific ETFs. They've been, so far in 2025, taking money out of semiconductor-specific. Some of that money has gone towards quantum computing, a fascinating topic in and of itself. Some of that has gone to cybersecurity. Some of that has gone to AI. Some of that has gone to China technology, which is an interesting topic in and of itself. So it's been fascinating to see in 2025 a bit of a shift in how ETF investors are thinking about technology and where they want to place those bets.
That's great. And Chris, as a follow-up from WisdomTree's perspective, when you see all these inflection points in businesses and capturing that change in trends and how companies are evolving, even from a percent of revenue and a profit standpoint, how does WisdomTree account for some of these new names in the ETFs?
Yeah, so, for the last few years, we haven't needed to account for them in the IPO market because that's been, people are probably seeing headlines all the time, and we're watching and going to see if CoreWeave actually goes through fully with their planned efforts. It's obviously getting a lot of publicity, partly because of CoreWeave, partly because there really just haven't been IPOs, and there are these gigantic private companies just sort of sitting there. But you're right to note that part of what we'll do is we'll look at various databases and sources and try to determine. Now, the funny thing about AI is there isn't a pure definition of this is exactly what AI is and this is exactly what AI is not. So you need to have the data, we think. You also need to be able to exercise the judgment and opinion to determine, based on what a company is saying that they do, is it truly AI? Is it something else? Is it something we think is a compelling enough story? Where AI today makes the most, say, revenue contribution, I think, is still sort of various forms of advertising and content recommendation. As boring as that sounds, we all, partake of streaming platforms and things like Amazon Prime and the Google search engine. And these things, even if we're thinking about what may disrupt them, they're still making a lot of money as we sit in these seats today. And a lot of what we're trying to do is to say, well, what happens after that? Because there was certainly a time before all of that, and there's going to be a time after it. But one of the hardest things to do in markets is sort of accurately predict how that disruption ultimately plays out. And we're talking about some of the biggest and most successful businesses ever being disrupted, if in fact that comes to fruition.
Right. Now that's interesting. And speaking of disruption, Krishna, as you look at the AI landscape broadly, there's a lot of applications of AI, whether we look at healthcare, financial services, consumer, all these industry verticals that are seeing change and disruptive change. How do you account for that, as an investor, and start looking at those opportunities? And what are some key sub themes that many investors who are joining us today should look at more carefully?
Sure. So Parnassus is a bottom-up fundamental stock picking firm. We've been doing that since 1984, and whether it's AI or any other theme, we look at companies' mode, the quality of management, the relevancy of products and services, and sustainability practices that the company, how it ranks on that spectrum. And AI is no different. From that perspective, I think from bottom-up perspective, I would say, kind of alluding to what Chris was saying, but looking at three different buckets. One is the enablers bucket, the providers bucket, and the adopters bucket. And these will benefit at different times. Today, the enablers like NVIDIA, platform companies, companies like Microsoft are certainly the forefront of AI, but then you're seeing investments and a lot of effort from providers like a CRM that's talking about like agents and other software companies that are trying to build agents for their software. And then eventually you'll see, in fact, you're already seeing early signs of companies that are more downstream that will be the actual adopters of AI. So it could be something like a John Deere trying to use AI for its precision agriculture. It could be a company like Verisk Analytics that uses AI within insurance underwriting, and so we kind of look at that on a sort of like what company will benefit at different stages of the cycle. I do believe that this is a very long runway for adoption, probably similar to, and in fact probably bigger than what we saw with smartphones, PCs, and social. And so what is important as a bottom-up stock picker is to kind of identify the right company at the right stage in the cycle. And I would just add, like, just got back from GTC last couple of days, and I would be remiss if I didn't add one other framework for looking at that Jensen Huang laid out, which is, the initial stages of AI is like perception AI, which is like, image recognition. We are currently in the generative AI, and Chris mentioned, Chat GPT and content generation tools, and then moving to agentic AI, and then eventually like physical AI, which is like robots and autonomous vehicles, some of which we already see. So that's probably like a broader framework, and individual companies sort of slot in there.
That's very helpful. So 2 quick follow-ups for you, Krishna. For our audience, do you mind just clarifying generative AI from agentic AI? Because you're right, agentic AI is the future. So how do investors think about both of those buckets?
Sure. So generative AI today is largely is a more consumer-oriented or consumer enterprise, consumer/enterprise, like consumer-oriented enterprise application where you've kind of ingested the whole internet, not so much the internal company data, because obviously ChatGPT and Anthropic, they don't have access to it. And then you're trying to develop what most people call foundational level of knowledge. And it's not specific to what a company does, but it's more like if you were talking to like a general person, they would go on the internet and search and write something back to you. It could be, hey, tell me, write me a poem like a Taylor Swift would do, or something to that effect. But it could also be generally available knowledge that is on the internet about specific topics, such as you could be a physician and you want to ask, hey, how do I kind of treat this, or what drugs are used? That may not be understood by the general public, but it could be understood by someone who's trained. Agentic AI is the next step where you take this base level of knowledge and you infuse with context-specific or enterprise-specific understanding. So these would be processes, workflows, and data that is more proprietary to within the company. Think of like a chatbot agent at Bank of America that could know the policies, procedures, the security protocols within Bank of America of interacting with the customer, but have a certain level of agency, which is to say that in a normal software, we click something happens, then we have to click again, and then something else happens. Whereas in an agent, it could be more autonomous. It could act on your behalf with the required guardrails. Whereas generative AI is more, you ask something, it kind of tells you, and then it waits for you to interact. But hope that.
No, that's helpful. That's very helpful. And I think it's important for those dialing in to understand that differentiation, given the feedback that we're hearing, even in the private markets about, some of these technologies. So it's always a good precursor to what's to come, in public markets, which is very helpful. In terms of other areas, and I almost think about this analogy, right? We all know the gold rush analogy. You want to invest in the picks and the shovels, right? And thinking about that. In terms of that, are there areas in other second derivative plays on AI that we want to be mindful of? And maybe, Chris, you could highlight something in cybersecurity. I know that's an area that you all have looked at and built some great ETFs in as well. Anything you want to comment there?
So cybersecurity, one of the things we always think whenever you're hearing about that next new technology, and it certainly we certainly agree with Krishna in the sense that we're going to be viewing AI as that next new technology for some time. But as people adopt these new things, they also have to be thinking on the security side, because you can bet that there are people who may not have the best intentions who are thinking, okay, I've got a new tool here, and I can use that tool to fake someone's voice, to create a video that possibly never even happened, to fool people. Usually the idea at present is not using the technology to somehow break down the firewall. Usually it's use the technology to fool a person into taking a particular action, sending money to a certain destination that otherwise is nefarious in some means. And so knowing that is the first step that we all need to have in mind to sort of protect ourselves, to recognize calls from unknown numbers these days take on a totally different level of significance, because it may not even be a person that you're speaking to. But then you think from a cybersecurity perspective how there are all these companies, and one of the interesting stats that's out there is you think of the general business like a WisdomTree or a Parnassus, or Krishna was mentioning a Bank of America, and you say, okay, how many cybersecurity platforms do you think these businesses might subscribe to on average? And it's certainly not 5 or 10. It's 40, 50, 60, in some cases more than 100, depending on the legacy and the cybersecurity practices. Because usually what happens is people are very afraid to cancel those old subscriptions because they may not always know what they tie back to and what they're ultimately protecting from. And so you see a proliferation of cybersecurity tools, you see a proliferation of cybersecurity companies, and you see that just this week, Wiz is a great example of being potentially purchased, if all goes through, by Google for around $32 billion. And you say, wow, this is a relatively new company, obviously extremely valuable, extremely good at protecting from certain elements here and threat detection and mapping out what's happening from a cybersecurity perspective. And so what you're getting is a value to being perceived to be on the cutting edge and to be able to keep up with the various threats as they are continuously evolving. And so companies like SentinelOne and Palo Alto and Okta and CrowdStrike, many of us with Windows PCs might remember July of last year, and CrowdStrike made a mistake. And I admit I couldn't turn on my computer for a day or so, but it was quickly fixed. And you basically look and you say, what is the retention on a gross basis of CrowdStrike? Meaning, in general, like, did they lose a lot of customers based on that? No, not really. The share price, it might be down in the recent downdraft, but it did actually recover from the July 2024 event. And their gross retention ratio as of last reporting is still 97%. And so what you see with a lot of these companies is there is a lot of work that businesses do on the front end to adopt new software. There is a lot of hesitation to cancel those subscriptions. They can cancel them. It's not impossible. But some of those revenues are stickier than you otherwise might think. And so the behavior of revenues and cash flows in some of these companies could be more stable than, say, software companies of the past.
Yeah, and that's interesting, and actually sets us up nicely for what I'm really most excited to talk about, which is NVIDIA. And GTC and just the short-term and long-term implications. Because Chris, to your point, there are some long-term thoughts that we want to think about as fundamental analysts. At the same time, you need to navigate through the short-term noise. And just given the landscape that we're in, Krishna, I have to kick it off with you here. With the valuations coming down, broadly speaking, on AI, all the macro uncertainty with tariffs and beyond, and everything we're hearing, both from the political front and possibly economic growth slowdowns, how are you broadly thinking about the landscape today? And if we can dive into NVIDIA and thinking about that name as well, as that has had a lot of short-term pressures with the DeepSeek situation, but now we're hearing once again from Jensen about the opportunities in AI CapEx spend. So how does one think about the landscape for AI in terms of the short-term noise and the long-term excitement around the space, and then specific thoughts on NVIDIA?
Yeah, sure. I think the semiconductors are cyclical. That's just something that a wider investor base is sort of realizing, because it's such a large part of the index now. But I would say we're kind of in a mid-cycle correction. But if you think of the long-term demand profile, the long-term adoption curve, this is still going to be a pretty important company, a pretty important team to bet on. And I spent a couple of days at GTC where Jensen was very generous to spend time with investors. He had a cocktail reception and a Q&A. And I think there are three things that he made sure to emphasize again and again. The first thing is that compute demand, so demand from hyperscalers and from enterprises, is strong, real. They're not seeing any kind of slowdown. The second thing he was trying to emphasize is DeepSeek is actually a positive. And I'm sure your viewers, investors would have heard of Johan's paradox, which is that if you lower the price or the cost of a commodity, the usage goes up. And so while DeepSeek has made a lot of great algorithmic progress to, do things more efficiently, I'm in the camp that this will enable more people to adopt it, and people will spend more because they get more value. And there are parallels to this in compute, like CPUs have been writing Moore's law for many decades, and we're not using less computers; we're just using more computers. So that's certainly going to be the case with DeepSeek. And the third thing I would say, which is very interesting, is that most people think of a company launching a product as, oh, you're telling me what the next step is. Whereas what NVIDIA is doing differently is telling you the next 4 products in the pipeline. Like Apple doesn't come up and say, hey, here's iPhone 20. It tells you iPhone 16. The next year tells you iPhone 17. And the reason why NVIDIA is doing it, because it has become so central and critical to the supply chain and the planning that it takes for data centers, TSMC, the semi-cap equipment providers, the industrial companies that build the HVAC, that if they don't specify the specs for a lot of those things 3 or 4 in advance, it just takes so much time. So long story short, we're still in a demand exceeds supply situation for the foreseeable future. But having said that, I get why the stock is kind of trading in this sort of mid to like high 20s range, which is, investors go like, what have you done for me lately? And that's the vibe I got even at GTC, where a lot of the sessions, a lot of the topics were less focused on the hype around AI and more about like, okay, now let's move from this hype stage to how do we implement it. And I get that, that's a little not as exciting for investors, and they want to put up perhaps a lower multiple. But the earnings trajectory, the product trajectory in terms of both how many chips they'll sell this year and the demand profile for the next year seems pretty strong. So, I understand the correction, but I'm not too worried.
Not worried. What about the margin profile, Krishna? I know with concerns around DeepSeek, there was concerns about that pullback, and then they reported a pullback on the gross margins. Is that a concern for the business model going forward as well?
Yeah, so I think the margin concern is more about the ramp of the product itself. So Blackwell marks a pretty significant shift in architecture compared to Hopper. So they're ramping up capacity at TSMC for that, but they're telling a lot of other suppliers to ramp capacity. And in that stage in the cycle, I'm not surprised that margins are a little bit lower because these businesses operate in economies of scale. But I think Jensen and Colette, the CFO, was very emphatic in saying that these are timing issues, and as they get more scale, they're already sold $11 billion worth of new Blackwell GPU, and expectations are, that will continue to compound. And so as that happens, I think margin should be more a transient story, and less of a long-term concern. But having said that, in the very long term, could there be some normalization? I think it's possible, as particularly as there's a big debate about ASIC chips and hyperscalers trying to insource some of the chips. So that's possible, but I think that's kind of a very long-term issue. But in the near term, I think people have gotten too concerned about margins. I think that should be more cyclical.
And it sounds like if the CapEx story continues to accelerate, there's that long tail. And he talked about robotics as well, right, as $1 trillion market. So folks may get more excited if we start seeing that reacceleration again, and possibly sounds like valuations may come back. And this might be an interesting time to look at the name.
Yeah, and I think one of the things that I feel like people are missing, and Microsoft talked about this on their earnings call, is you have to put the building, the HVAC, and the connectivity and the physical apparatus first. And so the big bump in CapEx, the proportion of CapEx that is being spent on physical things versus electronics is perhaps higher. Obviously, they don't disclose what exactly it is, but Microsoft alluded to it that that's higher. So even if CapEx actually stays flat or only grows let's say mid-single digit, which is what maybe most buy-side folks probably expect, flattish to slightly up, the proportion of CapEx that is spent on servers and chips actually could go up, and that perhaps is sort of the disconnect, that right. Most people don't believe that CapEx will go up dramatically, and so they're taking that as maybe the cycle is peak.
Right.
But I think it's important to recognize sort of what is the proportion, because the numbers are getting so large that that's hard to.
No, which is right. And I think that's why, going back to the earlier comments about the entire landscape, and Chris, your earlier points when we're talking about value chain, it's important for folks to understand, what constitutes AI, and the AI infrastructure that NVIDIA talked about, and the AI factory. What does all that mean, right? Where are all these investment dollars going? And it's thinking about this as a solution, not just, one specific area. So it's very, very interesting. And we can't move away from AI names like NVIDIA or Broadcom without talking about the China trade wars. So Chris, just to come back to you at the highest level, how should investors be thinking about that current trade war with China, broadly speaking, across both U.S. and China investment plays? And given your coverage on a very global scale, maybe you can comment on that, on how you're thinking about it from a thematic lens, and then Krishna, back to you on the stock specific components.
Yeah, so it's obviously a different world in the sense I graduated from university in 2006, and at that time, what was usually taught, I majored in economics, so there were not classes being taught that were saying, look at all these benefits of tariffs here and tariffs there. It was very much the benefits of Ricardo and free trade and comparative advantage, and Tom Friedman had written that book, The World is Flat. And so it was very clear the world was moving in a certain direction. There were certain assumptions that if you bring China into the global economic picture, that accomplishes maybe certain other geopolitical goals that you might have. And it's looking like some of those suppositions are not bearing out, and we're now seeking to go in this other direction. And one of the things you see in the world of AI and the world of semiconductors that I'm sure Krishna sees as well is in the Biden administration, it was about the government puts a program in place. It might be the Inflation Reduction Act, it might be the CHIPS Act, and the government, puts some funding behind an initiative. And that initiative is basically geared around the fact that, it was a bit of a problem when the United Auto Workers couldn't actually sell cars because they couldn't actually get chips at various points in time during the pandemic. So we need to make more chips in the US. And it's interesting to see the Democratic administration response to that, some sort of a program and 50 billion in spending. Now, if you look under the hood, you say, wait a second, one factory to make the most advanced chips is 20 billion. The whole program of the CHIPS Act was, at least the headline figure was around 50 billion. And so you say there's a bit of a disconnect there, and you look, and it's been widely publicized. Intel might have been getting the most money, 6, 7, 8 billion. And TSMC to build certain plants in Arizona might have been getting 5, 6, 7 billion from the US government and various tax breaks and state level benefits. So you saw all of that happening. And then what you're seeing on the Trump administration is they're using tariffs to basically say, you can put your production in the US, that's great. If you don't, you're going to face a tariff. And that percent might be 10, 25, 50, depends where you are with that factory. And so you're basically in a position where companies that are thinking about that CapEx equation. And on the other side of it, you see Apple announcing we're going to put 500 billion in the US. You see Oracle and SoftBank and OpenAI saying we're going to put 100 to 500 billion in the US. You're seeing all these big companies that are doing the spending on the stuff that Krishna was just describing, adjusting and making sure that they publicize, even if they were going to do it anyway, they're republicizing how much investment and jobs and economic activity they're focusing on bringing into the US to gain favor with the Trump administration, to then allow them to keep going. Because what they obviously don't want is they don't want a European scenario where there's all these regulations on the new tech and the new stuff coming out. They want to be relatively unfettered. And it's looking like to be able to get that done in a Trump administration is you just have to keep emphasizing you understand who's in charge and you understand, look, we will put our production and economic activity first and foremost in the United States.
Well, on that point, you mentioned a lot of the big tech investing in the U.S., and that is definitely going to be interesting to see how all that plays out in the next couple of years. So, Krishna, going back to your ESG diligence screening and some of these moving parts that Chris was talking about in light of the landscape, how does one take a given AI company, and we can go back to NVIDIA or anyone you like, where you put the ESG screening on that company, that you're thinking about all these puts and takes, right, from the energy side, the responsible ethics AI, as well as some of these considerations on where the CapEx movement's happening to prevent future supply chain disruptions. How do you think about all these puts and takes in light of the financial analysis you're doing?
Yeah, absolutely. So at Parnassus, we take a pretty comprehensive approach to thinking about sustainability. We think about how the company is thinking about governance, employee as well as consumer right, the misuse or product level safety, and then just how ethically the company is operating with all the stakeholders, in addition to thinking about the big picture issues like climate and the environment. So when you think about something like specifically like an AI company and perhaps like an NVIDIA, there could be two kinds of AI related sustainability issues. One is on the front of, let's say an NVIDIA makes chip, does it get into the wrong hands? Like, is the company following export controls? Is it going to be subpoenaed by the DOJ about not shipping to state actors that it should not be shipping to? So that's like one category of risk. And in general, I think most large companies are very, very deeply involved with conversations with the administration. They may not agree with all the policies, and some of that might be beyond the traditional scope of sustainability. But I'm fairly confident that there's a lot of conversation going on. The second category I would say is around product safety. So that could be something like an insurance company that is using AI for underwriting claims, but maybe there's a bias involved, and so that provides an opportunity for us to engage with the company. But also most companies, because they have to really think about generative AI and agentic AI in the context of how would a human respond to this, they have to have the same lens, the cultural context, the organizational context what is considered right behavior, approved behavior, versus, you can't be very robotic about it, right? So I think a lot of companies, perhaps the reason why investors are a little bit concerned with the adoption rate is simply because those are real issues that you have to solve. But once you solve them, once AI gets like sufficiently advanced, I believe that unlocks like a step function change in adoption. Yeah. So those are perhaps the two big categories I would think about.
Have you faced situations where you've looked at a company, the fundamentals are great, but the ESG screening criteria is a little bit on the fence and it makes you second guess that investment?
Yeah, I mean, not really second guess the investment. I think most companies, the way we think about it is like, they are all on a spectrum, right? Like there's no, there are clearly some companies that are perhaps bad actors, but most other companies, they go from they're improving constantly. So, and that's what we expect. We don't expect perfection out of the companies we engage in, but we expect that directionally they're moving in the right direction. And I just point out, like, we own Verisk Analytics, which is a leading provider of analytics for the insurance industry, and we had an engagement with them about how their policies about making sure there's no active discrimination and active they're thinking deeply about it, and we got a very positive response from the company on that front. And so that's an example where a sustainable investor can not only benefit from the strong moat and the relevancy of the company, but also have an opportunity to influence in a positive direction the outcomes in the context of AI.
Got it. And probably, I'm sure greenwashing is something that's top of mind in terms of what companies are doing, what they're really doing, right? What they're saying, what they're doing. So that's interesting. Just for the audience, feel free to drop in questions. If you have any questions, we will be wrapping up in the next 8 minutes. So happy to answer questions. Otherwise, I have plenty of mine, so I will keep going. Chris, I want to come back to you on some of the active and passive trends. It's no surprise to anybody on this call of how the passive trends have been so strong. As you think about the ESG screening criteria from WisdomTree's perspective, how does that get incorporated into the WisdomTree ETFs? And specifically, really to better understand, when we look at a lot of these passive ETFs out there, a lot of them have the Magnificent Seven as their top holdings. So one has to wonder, like, how is ESG screening really fitting into some of these passive products? And I'd love to hear your perspective on it, being knee deep in this.
Yeah, so the thing about WisdomTree is we have a global business. So we have our European focused strategies, and the European market, what they demand is sort of like a baseline level across almost any strategy. So the strategy could be high quality global equities. The strategy could be AI, cloud computing, cybersecurity. But the audience wants to know, yes, you have that strategy, but you're looking at, certain UN global compact screening. You're looking at thermal coal, tobacco, certain baseline controversial weapons, certain baseline things are being screened out if and when they're potentially getting into whatever the strategy might be. On our US side, the market doesn't really demand that, at least not presently, and it feels like the political environment seems to be going in an opposite direction. Now, it depends in some cases what state you're in. If you're in California, it's different than if you're in Florida or Texas or New York. So certain states around the US might have different investors with different perspectives. But what we tend to see is you might have a topic like battery and energy storage solutions, which is sort of an ESG topic. And we'll have that sort of strategy available to US investors. But our general, say, AI strategy or cloud computing or cybersecurity strategy in the US doesn't necessarily need a ESG screen over and above. Essentially, people just say, what I want is the best ideas in AI, and I'm not necessarily thinking about how ESG comes in on this particular topic. What's been interesting to watch in Europe, and you might be seeing an evolution of views, is right now, Europe is very focused on defense and weapons, particularly amongst European companies that provide those things. So a few years ago, you would have said, weapons? No way. This year, you might say weapons. Actually, we have to take a bit of a nuanced picture now, because as a government, we actually want to encourage that, and it's important, and we're sort of decoupling from the US. And so you do see, interestingly, even in Europe, which is very focused on this, it's not as set in stone as it might have seemed a few years ago.
Oh, that makes sense. And before we wrap up, in the last 5 minutes, we do have 2 questions from the audience here. First question, can you speak to company stage that you're focusing on AI investments, and the thesis and criteria for selecting your targets? So Krishna, I'll kick that off to you. So it's going back to that life cycle question.
Yeah, absolutely. I think one of the benefits of active management is the fact that you can be a little bit early, and rather than just ride the momentum. And momentum is a very important factor in returns, and has accounted for like pretty sustained return profile from stocks over a long period of time. But in a theme like AI or robotics, like suddenly when you track companies that are doing small things within their businesses, like we've owned NVIDIA before the whole ChatGPT came on the screen, and that requires like active engagement, active dialogue, but also a willingness to perhaps endure some pain in the initial stages for an eventual gain in the later stages. And today I see so many companies that we hold that have some small part of their business that is not the entirety of their business related to AI. Like NVIDIA is like almost entirely now AI company. But I'll give an example, like Cummins. Cummins makes diesel engines for trucks, Class 8 trucks, but they have a data center business that is not the majority of the business, but supplies backup generators for data centers. Now, most people may not have thought of Cummins as an AI company, but if you kind of track that company, talk to the management, know where they're investing, it's sort of, that's the life cycle. You want to be, as an active manager, you want to be early to the theme, and then you want to capture as much of the upside as possible.
Absolutely right. And we noticed that even at RGS, when we were building out the thematic solutions, that you can do this broad search and you can run it via our AI algorithms, but then having that analyst touch at the end of it to really understand the business model, the value chain, where is that impact really happening, especially in AI, where everyone says they're doing AI, and you run all these screens, and you could just have one investment in AI and all of a sudden you screen. So having that analyst view and that active management approach is definitely very critical for the understanding the stages. And to close out, going back to robotics and some of Jensen's comments, in terms of robotic themes, Chris, do you all have maybe a robotics ETF or maybe some names that you can talk about that you want to highlight in the public markets for our viewers today? And then Krishna, I'll ask the same question to you afterwards.
Yeah, so it's fascinating to think of certain companies like Symbotic, where they are featured, I know, in the Walmart distribution centers. Amazon last year sort of took on the staff of a great company in robotics, Covariant. You can see the robots doing very interesting things. Hyundai, I mentioned because they actually own Boston Dynamics, if you remember the videos like with the robot dog and things of that nature. And then obviously Tesla is seeking to head down that particular pathway as well. So far there aren't a lot of just pure play robotics, but you do see robotics featuring more and more in certain other companies that are clearly diversified across, as Krishna was mentioning, the sort of virtual space and trying to get into the physical space.
Right.
Yeah, I would say the most underrated robotics company is Google. The depth of Waymo. I mean, I live in San Francisco, and I see so many Waymos flying around. Like it is fascinating. That is actually that is a robot in a car, and I believe that's probably the most consumer-oriented robotic application that we'll see proliferate. And obviously Elon Musk is talking about FSD all the time, and I know many people really like that feature. So I think from a consumer perspective, I believe that's probably a key low-hanging fruit that has a very long runway. But I agree with Chris that there are a lot of interesting companies that are perhaps in a little bit early stages of this evolution, where they'll be either part of a warehouse solution for Amazon or industrial automation that we don't hear about, but then these will become much larger and larger. I know Rockwell Automation is a company that's kind of doing a lot of stuff in that area. But I do believe that, yeah, this is an area where it would really help to kind of look company by company and identify a theme that is early, that might become like much bigger over the next 5-10 years.
Absolutely. And in summary, I think this market creates a little bit of something for everyone, right? We've got something for the short-term folks, the hedge funds, right? The political noise, macro uncertainty, the long-term trends we're hearing, especially coming out of GTC. So this is very helpful. I want to thank you both for your very insightful comments. Great conversation today. And frankly, I wish we had more time. So we'll look forward to continuing this dialogue. And for anyone who has any follow-up questions, feel free to reach out to any of us via LinkedIn, and happy to continue from there.